Heads you win, tails you also win. One of the most difficult things in the stock market is determining which way a stock's going to go. Now, I'm a firm believer if you understand technical analysis properly, you can get an idea whether the stock's going to move up or move down. Now, I'm not saying that I can predict where a stock will be a year from now, a month from now, or even a week from now, but at certain times, I know where that stock's going to be in the next few minutes or few hours. For those of you that don't have the technical analysis skills like I do, and for those of you that do, I'm going to show you a strategy that it just doesn't matter. Now, option buyers are rewarded for being directionally correct. In the old days, that's the only way you really could make money. You had to buy an option on a stock that was going the appropriate direction. You'd want to buy a call option if the stock were going up, and you'd want to buy a put option if the stock were going down. Today, it's much, much simpler. This strategy, we're going to play both sides against the middle. All you're going to need to know is how to follow the rules. So pay attention. I'm going to show you the rules to directionless trading. In this next strategy, you're not going to need to know how to read a chart. All you're going to need to know is how to follow the rules. So listen carefully, take good notes, and watch this DVD over and over again. Be prepared to learn to profit no matter what direction the stock market goes.
The whole point of the penny-priced options course is knowing rules. Not only rules for us as trader, but rules that option pricing has to follow. Options are priced based on Nobel Prize-winning formula, and this Nobel Prize-winning formula has a premise. And this premise is that options are priced without bias towards direction. I tried to take a screenshot with a stock right at a strike price to show you that there is no bias in the market. And I happen to take this at $7.02, $7.02. Again, understand the strike prices are at even 7. So the call options are going to be 2 cents in the money and the puts are going to be 2 cents out of the money. And you can see here that the bid ask on the $7 call is 42 at 46, and on the put it's 40 at 43. They're within a margin of error. And if you look at an options chain and you happen to look when a stock price is equal to a strike price, as long as the stock doesn't pay a dividend or there's some other extraneous circumstance, the call and put are going to be roughly the same. An interesting thing, if you look at the $8 put, it's got an ask of $1.13, and the $6 call's got an ask of $1.16. They're within 3 cents of each other, which is pretty close since the option's 2 cents in the money. The point of this is that it's proof that options are priced based on it being an even money proposition. It's heads or it's tails. It's on or it's off. It's up or it's down. There is no difference. This is where we get a statistical advantage, knowing technical analysis, knowing certain circumstances. Having said that, we don't need technical analysis. We just have to follow the rules in this directionless system here. We follow rules, and I tell you, any system that requires you to trade it perfectly is a bad system because you can't trade it perfectly. There is some slop in this system here. Now, mind you, if you follow the rules exactly, there is very little slop. I still want you to have realistic expectations. This particular strategy, this is not our 800%, 8,000% strategy. We're going to get smaller but steady positive returns. Now, in directionless trading, we're going to be using both call options and put options. And in directionless trading, I guarantee you we will lose money. Right, well, hold on. What did I just say? We will lose money? Yeah, we will lose money on one or the other. We're going to be buying a call and a put. What this is called is known as straddles and strangles. I like to give it the cute, memorable names of Straddle Battle and Strangle Angle. Now, a straddle is a call and put with the same expiration and the same strike price. A call and put, same expiration, same strike price. A strangle is a call and put, same expiration, different strike prices. The difference between a strangle and a straddle is the strike price choices. They both have calls and puts. They both have the same expiration. The difference is the strike prices. Right? A straddle will have the same. The strangle will have different ones. And I find myself using the word straddle when I mean strangle and the word strangle when I mean straddle. Straddle battle helps me to keep it more in line. It makes my brain think it through a little bit more. I told you we have to follow rules, but that options also follow rules, the rules of option pricing. Part of these rules mean that an at-the-money option is going to have a delta near 50, and an out-of-the-money options are going to have deltas of less than 50. Now, directionless trading is often known as delta neutral. And why it's known as delta neutral is because we're buying a positive delta with a call, and we're buying a negative delta with the put, and they offset. The way we trade it is we put a straddle on when it's at the money, and the deltas should be roughly plus 50 and minus 50. If you don't know what a delta is, that's because you're watching these sections in an inappropriate order, or you didn't pay attention. This is in the options and the math that goes along with options. We talk about the Greeks. Please study that if you do not know this. I would tell you to pause this course right here, right now. Go watch those so this all makes sense. Now, I'm going to continue under the assumption that you know what a delta is and how they are measured and how they move. With our strangle, we like to buy an out-of-the-money call and an out-of-the-money put, and they both will have deltas of less than 50. So here's an example. Plus 30 for the call, minus 30 for the put. It becomes delta neutral. Well, that's what the marketplace calls a trade, delta neutral. I actually like to call it delta zero, right? I like to call it gamma smile, right? Because gamma is the change of delta, and when this trade goes for us, we're picking up more deltas than we're losing, no matter what direction it goes, either direction. And so the gamma from where we're at is smiling up if you can graphically look at it. Gamma is what makes us win when we have a stock move our direction, right? And so directionless trading, we're going to get a win with a big move in either direction. Again, my gamma smile, we call it gamma positive. And the point of it is we have more gamma going into our option for us than we have coming out of the one against us. The penny-priced options trading system is really a gamma-based system, and directionless trading is a gamma-based system whether you realize it or not. Because gamma takes an option, delta, from whatever it is to a higher number, the strangle will outperform the straddle. And the reason is that the straddle tends to have the deltas at 50, and you can have one go from 50 to 0, and you can have one go from 50 to 100. You've gone from a combination of plus 50, minus 50 to 100. The straddles take the delta from near 50 towards the extremes. The strangle will take it from less than 50 to the extreme. And so there's more gamma going in the strangle when the strangle is right. Again, from 30 to 0 is minus 30, but 30 to 100 is plus 70. We're gaining extra gamma. We're gaining extra delta through gamma. Having said that, if the strangles outperform when we're right, if they perform just as well or better when we were wrong, we would never consider the straddle. But here's the bottom line. The strangle works better on a big move. On a flat move, they work worse. And what happens is that the call and put may end up both out of the money at expiration, and they both might lose 100% of the value. The straddles should always have some intrinsic value on one side or the other. The call should be in the money a little bit, or the put should be in the money a little bit. Therefore, one or the other should have some value. And if for some reason the stock is near the strike price at expiration, with some time left, there is some time value, and the straddle should have time value at the end. So when it goes bad for us, we'd rather be in a straddle. When it goes good for us, it doesn't matter which one. Well, here's the thing. You're saying to yourself, which should I do? Which should I do? I'm going to tell you. We've got rules to tell you which you should do. I just want to make you aware of everything that I possibly can before I start laying down a set of rules on you. I say the max gamma moves, if we have a positive delta on our call and a negative delta on our puts, we either want the call to have a delta of 100 and we'll accept the put with a delta of 0, or we want the call to be at 0 and the delta at minus 100. Imagine the move one direction or the other, and the big move generates this.